Got a special episode today. I am joined by two of my colleagues from the Blockworks Research team, Dan Smith and Sam Martin. Guys, great to have you here.
Appreciate it.
Thanks for having us, Jack.
You guys are going to start a podcast that will air on November 2nd called 0xResearch. And I want to hear all about that. But because it's a macro show, I want to ask, how do people in crypto think about macro? Every asset class this year has had a drawdown, except for energy stocks. But tech stocks, all sorts of stocks, bonds, interest rates are on the move. Every commodity except for oil is pretty much going down. So everything's going down. No one is having any fun except for people who own a specific type of stock. And crypto is no different. So, let's start with you. When crypto had a bad day, let's say the first day of the Blockworks Digital Asset Summit in September, Ethereum came in real hot. Sorry. Inflation came in real hot. And every single risk asset, the NASDAQ, S&P, bonds did very poorly, and Ethereum was sort of joining in the chaos. So when you have a bad macro day that results in a bad crypto day, how do you sort of think about that, and how do you navigate that?
Yeah, I mean, there's no denying like how bad macro has been year to date. I mean, the 60-40 portfolio, I'm pretty sure, is off to its worst start in the last 40 years. So crypto is definitely not any different on that front. We definitely suffer drawdowns in line with the macro headlines. I'm honestly surprised, though, that Bitcoin and ETH have been able to hold the levels that they have. We're still hovering, above 19,000 on Bitcoin and above 1,300 on ETH, and that's kind of been the floor. And where stocks and where bonds have gone has been pretty low. So I'm honestly shocked with how well it's actually held up. In terms of like macro trends that I pay attention to within the crypto space, Bitcoin dominance is often referred to as kind of like a macro metric in our little niche industry. And it's still hovering above 42%. And also, if you take into account the amount of stable coins that are in the space now and how much those have grown, I think those metrics are even a little bit more skewed compared to previous bull markets or bear markets, sorry. But in general, it's something that we need to pay attention to. And that's actually why I love working at Blockworks so much, because I'm always, talking with you, Jack, in Slack, or Byron, who writes the newsletter, or someone else, and trying to like just comprehend as much as I can on the space, because I know how important it is to asset prices and the way funds move on chain. But yeah, definitely not my area of expertise. And it's the reason I listen to your podcast every week.
Yeah. And Dan, I want to ask you the same question, but maybe also ask you, how do you, as an investor, think about navigating a bear market in crypto? In a bull market, it's easy, or at least, it seems easy in retrospect. You just go into the most sort of a risk apparent thing. I believe our colleague Matt was telling me it's called the left curving. So for example, in the summer of 2020 in TradFi, just like, why buy high quality stock like Apple when you can buy an extremely speculative electric vehicle company out of China? You know what I mean? Like something like that. Like just all risk. Like drive to put your pedal on the metal. And so in crypto, that's the same thing, like Dogecoin, stuff like that. But now that we're in a different regime, like, how do you think about navigating that?
Yeah, that's a great question. And, I would kind of like echo Sam's remarks. And I don't like, it's hard to see a world where crypto really, in terms of like asset prices, like crypto takes off and macro is just like kind of stuck in stalling out and just kind of fighting the uphill battle. So that it is definitely something we pay attention to. I'm definitely spending a vast majority of my time kind of like in the weeds and, studying tokenomics and things of that nature. So I just kind of like look at macro from like a sentiment gauge and like, okay, like, are we in an environment that would kind of be favorable to be investing in those high risk assets you mentioned, like the Doge coins of the world, or, some of the more Ponzi-like investments that exist out there. Try to stay away from those for the most part. But there's definitely been some good run-ups that we've seen, and some super high-risk assets. But in a more of a bear market, when things are kind of like, in this lull, and there's not like these crazy pumps you're seeing, I kind of like, first of all, I'm usually locked into stables and farming on. So when I say farming, that's like, depositing my tokens into liquidity pools and farming the rewards that you get for being an LP and providing your liquidity to those pools. So other traders will use your liquidity to execute trades. and in turn, you generate fee revenue from the transaction fees going through the pool, generally, as well as some liquidity incentives. So like the protocol will incentivize you to be in this pool. And so you can do this pretty effectively with stablecoins through the protocol Curve. So Curve was originally built to facilitate swaps between stablecoins. It's since expanded to also include like stablecoin pairs alongside like volatile assets like ETH or wrapped Bitcoin. And the returns can be they're obviously modest, right? When you see something like Dogecoin that does 1,000% gains, you're like, oh my gosh, like that's where I got to be. And if you're farming stable coins on like protocol like Curve in the depths of a bear market, you're kind of sitting around that 2 to 5% range. But I'm pretty comfortable when my assets are there. I'm in like high quality stable coins that I don't really fear about having to go through a depeg risk or anything of that nature. So that's generally my game plan, is to kind of sit and wait, and usually in these stablecoin farms. And then once I think, we're kind of heading a little more risk on, then I start buying like the blue chip assets, right? So for me, that's generally Ethereum. And now in the proof of stake post merge world that we're kind of in right now, the staking reward on staked ETH, so like depositing my Ethereum to help secure the network, that's hovering around like 6 or so percent. And that's like a great way to just kind of be earning Ethereum on your Ethereum. So that's kind of where I'm at now. Currently, I'm adding a little bit more risk. I'm feeling a bit more comfortable with where we are, and the market's kind of shown us a good run up these past couple of days. I think we're up towards the $1,500 range on Ethereum. So yeah, I'm a big fan of like trying to always just be earning like passive yield. And for me right now, definitely looking at liquid staking solutions for Ethereum.
Yeah, just to touch on that too, Jack, if you don't mind if I butt in, like I think two important points to add there too are, I think we've lost a lot of institutional like capital just because bond yields are so high right now. Like it's not really worth taking the smart contract risk, the custody risk to deposit into these stable farms if you're making less than you would on the 10-year. So I think that's really key. And then I also think another key differentiator in a bear market for crypto versus equities, let's say, is there's always a narrative. Like, for example, there's this one perpetuals platform that lets you speculate on Forex, and that token has popped off because people are speculating on Forex. If there's something to speculate on in crypto, it will be speculated on. So I think there's always an opportunity to make money, but yeah.
And just to be clear, Forex, that's TradFi Forex, that's foreign exchange, like currencies, like Japanese yen, stuff like that.
Correct. Yeah. So with all the currency volatility, like that was kind of a narrative that if you would have used your macro hat and then also your crypto hat, you probably could have sniffed that one out and made some good money.
Yeah, there we go. And Dan, just a point about you in a period of risk off, you're going into stablecoins. Stablecoins are like bonds in that they are supposed to be safe asset. You mentioned that depegging risk, and that depegging risk can be quite extreme. But if the stablecoin is backed by something and it maintains its peg, you're getting 2%, you're getting 3%, and you're not taking that sort of like mark to market risk. So that's just a parallel that when in traditional finance, when stocks sell off, almost all the time bonds do well because there's a bid to safety. That's why this year has been different because of inflation. So you're saying now, Sam, 10-year yields higher than the stablecoin yield.
Yeah, stablecoin yields right now are somewhere around 1.5%. So it's just not really worth the risk, especially for professional money managers. Even some people who are crypto native funds, like they're better off parking their capital in bonds and not in stablecoin pools. So liquidity just isn't quite as good as it was during the bull market, of course.
Right, and just to kind of go on that point, if you're going for like the least risky way to earn yield on a stablecoin in DeFi, that would be depositing your asset into a lending protocol, like pretty much only Aave or Compound, in my opinion, because those are two very well respected, very established DeFi protocols, and they have a great teams that built them. They were around and have innovated significantly since their inception. And it's definitely not still a non-zero chance that like an exploit occurred on these protocols, but it's quite low, right? Like there's billions of dollars that have been sitting in these smart contracts for years now, and they've yet to experience an exploit. So that would be like your lowest risk way to earn yield. And as Sam said, like, yeah, the stablecoin rates are not great. They've dropped from the past 6 months. They've fallen from about 2% to 1%. And so, yeah, like if you can earn money in the 10-year backed by the U.S. government, like that would definitely be the better option at the moment.
And I guess that it's all about supply and demand. The reason that stablecoin yields are so low is because everyone wants safety and no one wants to borrow. So that's the demand for the asset, but demand to borrow is very low because no one wants to borrow to buy Bitcoin, or far fewer, right? So there's no pressure driving rates upward.
Precisely.
Yeah, exactly.
Yeah. That makes sense. So I know you guys have prepared a lot of interesting charts.
Yeah, so this is a site called Ultrasound Money, or ultrasound.money. And it's a great way to visualize the supply change for Ethereum post-merge. So the merge occurred about a month and change ago. And that was a transition from proof of work to proof of stake consensus. So proof of work is, we'll kind of like touch on what these things are. So proof of work is a consensus algorithm that is essentially you have to solve a very complex math problem to basically prove that everything is correct in the block. And once you solve that problem, then you get the reward, and that block gets added to the chain. And proof of stake works a bit differently. So they're no longer miners; they're now just validators. This changes a couple things. One of the most important takeaways here is we now have like a rigid 12-second block time on Ethereum. So every 12 seconds, a new block gets added. And so one of the biggest changes here is without this need to constantly incentivize miners to be verifying blocks, we now can reduce the supply of Ethereum. We don't have to be paying these massive block rewards to miners to come solve these math problems for us. And what this has done is created an environment where the Ethereum, the asset, can become deflationary. And so if you see there in the top right, it says supply change since the merge, and that's 1,000 ETH. And so if we hadn't merged and we were still on this proof of work network, we would actually have created about 491,000 ETH, which is roughly about $750 million. And miners want to take this profit and lock it in because they have electricity costs to run these machines. And so they're generally selling a portion of this reward that they're earning essentially to cover their costs and to lock in a profit. So we've basically removed around $750 million worth of sell pressure from the Ethereum ecosystem right now. And that's pretty crazy because there's been little to no on-chain activity in the depths of this bear market. Gas is generally right now it's at 21 Gwei. So the base fees are quite low. And we've seen this inflationary, this recent change to deflationary. And this is just, there's a big takeaway here is okay, well, when the bull market returns and on-chain activity gets really hot again, and everybody's trying to take out leveraged loans through Aave or Compound, or there's more incentive to try to chase different trades going through Uniswap. There's other DeFi protocols. Maybe a new NFT primitive comes to the scene, and now NFTs are hot again, right? There's more reasons to be transacting on chain. The base fees will increase, and more Ethereum will get burned, and then the supply chain change will likely turn negative, and Ethereum will become a deflationary asset. And I think that's going to be a huge narrative we see get pushed throughout the return of the bull market.
Okay, thanks, Dan. Just to rather than say explain things for the audience, explain it for myself. So on a day when Ethereum's up 6%, odds are Bitcoin is going to be up as well. Probably a little bit less than that. Cardano is probably going to be up. Polkadot's probably going to be up. And I feel you see that in TradFi too, where realized correlations between stocks, particularly in an index, particularly the biggest ones, are high. If Apple's up 2%, unless it's an earnings day, which I actually think it is literally today, then you're going to have, Microsoft's going to be up as well. So that makes sense. But then, so that's sort of the macro thing, which is, what this show is all about. But in traditional finance, I'll be first to admit, on the long term, you really did get a big difference between which company is going to be better, Cisco or Apple. That's a huge difference. So that is where I feel a bulk of the Blockworks research comes in is on which protocols are good and stable and growing and have a lot of talented people working for them and are launching new protocols that are actually being delivered upon and not just like hype, and which are sort of just like BS. So I think that's important. And so what you're saying is that, yeah, this transition from the ETH merge, and I'm not going to pretend that I understand this, but like I actually think I interviewed a crypto miner the day before the merge. So it was like their last day mining Ethereum, and they would have gotten rewarded by that 750 million. Now they're not. So the supply is not increasing by as much, and then also the supply is affected when people use it a lot, like by burning ETH, excuse me. So like when if people want to do tons of stuff like flash loans, like NFTs, as you were saying, they burn ETH. Now, not a lot of ETH is being burned because it's a bear market, not a lot of on-chain activity. But when that returns, you're saying it will go down. So your outlook, like obviously this is relative to the whole crypto market, but your outlook on ETH, Dan and Sam, is quite positive. And I think most people who, to me, seem like they know what in crypto sound like they typically agree with it. Would that be fair to say, Dan and Sam, that your outlook on ETH is positive?
Yeah, there's just a huge ecosystem that's built on top of ETH. The L2 scaling solutions are starting to come to life. We're seeing a lot of traction gaining there. I think the deflation narrative literally cannot be understated. Once that number goes negative, you're going to see that all over Twitter. That's what people are going to be talking about. That's what's going to get circled around. Every now and then crypto gets its moments on CNBC, and that's what they're going to be talking about, is how there's this like new deflationary asset.
Yeah, and even Bitcoin itself, like it has about a 1.75% inflation rate per year right now. And I mean, if you look at that chart, like it's 0.009, and that's during bear market block space demand. Like once that activity picks up and it becomes deflationary, you no longer require a new marginal buyer to pick up that extra issuance. So that's really the only asset in crypto that has that quality. So I think it's super valuable.
All right. Two of these charts I feel like are a little over my head. Let's actually look at this stablecoin dominance index, which we were looking at earlier, which makes a lot of sense. So this is what percentage of the market cap of crypto is in stablecoins, which are essentially bonds. And yes, bonds, as in TradFi, bonds can go to zero in TradFi, but stablecoins can go to zero in crypto. But that being said, like they are sort of the risk off thing. And yeah, a year and a half ago, they were less than 5% of the market cap. And now, wow, they're over 15%. So a huge rush to safety that we're seeing there. That makes sense. All right, Dan, so you just shared a chart with us, and I'm seeing it says bribe revenue. So what is bribe revenue? What are all these terms? What is CVX? What are we talking about here?
Okay, perfect. So first of all, we definitely need to pick a new term for this as an industry, because bribe has such a negative connotation in like everything other than this one subset of crypto. But this is the rewards that flow to CVX token holders. And so CVX is the protocol asset of a platform called Convex Finance. And Convex Finance is a yield aggregator that's built on Ethereum mainnet. And basically, the purpose of Convex is to simplify and amplify returns for users. And so if I'm a liquidity provider into another protocol called Curve, Curve is a decentralized exchange that facilitates swaps between assets. So if I'm a liquidity provider and I'm letting other traders use my liquidity to facilitate swaps, then they're paying me fees to do so. The liquidity management section of this is like, it's not like super user friendly, and like maximizing your rewards takes a bunch of work, and it's like there's a whole lot of maintenance that goes into it. So Convex was built just to like basically abstract that all away from the user, and basically instead of directly depositing my assets into the decentralized exchange Curve, I can instead give them to Convex, and Convex will take everybody's assets together, deposit them into Curve on our behalfs, and then do all this like maintenance work on the back end to be maximizing the returns that flow to the users. So in essence, like we throw Convex into like this yield aggregation subsector of DeFi. And again, like their main purpose is to simplify and optimize. That's
okay, so that sounds like kind of like a bond ETF, like rather than just like, oh, I'm buying a bond of some company which, the minimum bid is like probably like $1 million or something. Like, how about we put 1,000 of those bonds into an ETF and I can buy one share of that ETF for like $10? My question is, are those who chooses what are the yield protocols? Like, is it just a passively managed like all the protocols, or is it like a rules based approach, or are they being selected by a particular person?
Yeah, so this is a rules-based approach. Convex has they service two protocols, Frax Finance and Curve Finance. And within each of those protocols, they have their own set of rules that are slightly different, but like the same general premise. And so, yeah, there's when I give my assets to Convex, I'm telling them specifically where I want them to go. And so they do all this back-end work, and that's generating a ton of revenue for their users. And so they use a portion of that revenue, and they can kind of point it to different users, user groups within their protocol, right? So the LPs get about 90% of this revenue, but then so let me back up. So the way that they maximize rewards for these users is by they own a large portion of the governance token for Curve Finance. And so owning the governance token for Curve allows them to control where new emissions go. So basically they are actively voting in which liquidity providers are getting the most rewards. And that's kind of how they are able to maximize returns for their users. And so that's the goal of this protocol is essentially, again, to optimize and simplify. And so the governance token of Convex Finance is CVX. And when I lock that in the protocol to basically confer, that gives me governance rights over Convex. And that token, CVX, has pretty consistently generated between a 20 and 40% return.
Paid in what? Paid in Convex? You stake one Convex, you get 0.2 Convex over the year, or 0.4, depending,
Yeah. So the beauty of these rewards is they're not just inflationary rewards like a lot of these protocols do. This is very much so real yield. You actually get no inflationary rewards in this 20 to 40%. And so this is, so it's real yield, and we'll get to what it's paid to, or what it's paid in a second. And so,
okay, but I feel, sorry. I feel like when you say, so non-inflationary would mean that it's paid in Curve, the CVX, the Curve token, because it's if I'm, if you're borrow from me like Jack coin, but I'm paying you 100%, but I'm just making money from nothing because that's super inflationary. So what is it paid into? Because I feel like that's a really important question.
So you're paid in protocol revenues, and so then the obvious question is, okay, well, where are these revenues coming from?
Oh no, but what is the protocol revenues denominated in?
Right. So it's a variety of tokens. And so it'll see that chart on the far right there, it says VLCVX bribe revenue. The VL in there just means that I've deposited my CVX tokens into the protocol and I'm getting governance rights in returns. So the bribe revenue there is in a variety of tokens. The dark purple on the bottom of this chart is Frax. So that's a stable coin you're getting paid in. And then the other protocols, or the other bars on this chart, are other tokens. And so the reason why other protocols are willing to pay CVX holders for their votes is they're saying, hey, you have a ton of these voting rights that will send liquidity to my pool. So I will pay you to allocate these voting rights in a certain way. And so they're essentially renting liquidity from Convex voters. And so I know this is a crazy concept, but basically on-chain liquidity is incredibly important. If I'm a protocol and let's say I'm launching a stable coin, then I need liquidity, or else my stable coin will lose its peg. Or let's just say, I want a large, maybe I'm not a stablecoin, right? I just have a token and want other people to be able to trade it. Large buyers or traders can't buy my token on chain unless there is a large amount of liquidity. So on chain liquidity is vastly important to having a successful, well traded token. And Convex is saying, hey, if we have a ton of votes and the ability to direct where liquidity flows, so if you have any interest in that, we're you can rent liquidity or pay our token holders for that liquidity. And that's been a pretty consistent 20 to 40% over the past, since January of this year. And so there's you'll see that kind of on the left side, you see vote lock revenue APR and bribe revenue APR. And so this bribe revenue consists generally around 90+% of the total revenue. So vote CVX is generating both of these. And like the easiest way to think about this is like almost like biweekly dividends, right? Like every 2 weeks, I'm getting a new check basically from a new like deposits from other protocols that are like, hey, you have a valuable asset that can direct liquidity to my pool. Here's some money for it. Like we'll vote on your behalf, basically.
Okay, thanks. So the purple is Frax, which is a stable coin. How much of the other colors, the other cryptos that is being denominated and what you're being paid are stable coins?
That's a great question. I actually have this chart up, so let me just look at it quickly. So Frax generally is about half of the protocol revenue. Like they are responsible for a good portion of this yield because again, liquidity is so important to them. And let's see, 1, 2. So of the last round, let's see, there's only one other stablecoin. So you're mostly getting this paid in volatile assets.
Okay.
But of course, like you have the ability to sell those into whichever assets that you choose.
Got it. Okay. Yeah. I mean, some of that went over my head, but I think that makes a little bit of sense. But the Convex governance token has gone down a lot this year, like many other assets. So it's gone from like 50 to 5, or maybe not that bad, but like close to that.
It's about that bad. Yeah.
Okay. So now you're getting paid 26% on the 5, and that's like a little bit over $1. But at the beginning of the year, that would have been like $10. So it's the dividends are going down nominally, but the yield is kind of staying high just because the token. So why is the token gone down? If it's not inflationary and so good, why is the token gone down?
Well, that's so you could. Right, because if the token was still, let's say, $50, and you can see on that chart on the right, like during the heat of the bull market, right, from like that December timeframe just until the UST Luna blow up in early May, like total bribe rewards paid to these tokens was upwards of $10 million, right? In some cases, closer to 20. But now we're down to that like $3 to $5 million range. So if it was still a $50 token, of course, these yields would be much lower because this calculation does run everything based in dollar terms. And so, when broader DeFi has taken a massive hit, like whether or not it should or shouldn't have, or they're good assets or bad assets, pretty much everything's down, 90% from the highs. And that's just because there is this massive, like there is the chance that like DeFi fails, right? Like crypto just like never really gets traction, never takes off. Like these are still the most high risk assets that are available, right? Like if you're looking at the risk of like a respectable tech stock or even like Ethereum's the riskier option every single time. So I think that's just a function of, this is still such a niche market that the potential of is so far from realized that we're going to take hits like this when broader markets fall apart.
Got you. On that happy note, guys, I think we got to start plugging the podcast because we're 30 minutes in. So tell us, what is the 0xResearch podcast? When does it air? How frequently is it going to air? Who is the type of listener who you think would enjoy this, find value in this? And yeah, where can they find out more? Like, is there a link we can click? Is there you're going to have your own YouTube channel? Where's it going to air? So Sam, you want to take this?
Yeah, for sure. So it's called 0xResearch, and it's a podcast hosted by analysts, kind of for people who want to think like a crypto analyst. And we're going to be bringing on a lot of interesting guests, interesting researchers from all around the space, and just kind of picking their brains and picking apart their research and trying to deliver that kind of insightful stuff to our listeners. Everyone's got like a million things that they have to read, and the list kind of just keeps growing. So we want to kind of give an audible way to digest research, so that way you can kind of learn something on your car ride home or something like that. So that's what we're looking to do. It launches on November 2nd, and it will be available on Apple, Spotify, and YouTube. And I'm sure we can drop some links in the show notes.
There we go. And who's going to be the first guest?
We're going to do internal. We've got Westy coming on to talk about proof of stake. Ethereum and how MEV works in that ecosystem after the merge. So that'll be a really good one that you won't want to miss.
Nice. Internal is good. You got, you've got an external guest, they're doing their thing, but like internal, they're part of your team. So that'll be good. I will definitely be staying tuned for that episode to air on November 2nd, and people are interested in crypto and listen to this, they should check that out too. Sam, Dan has been like dazzling us with his charts. I feel like you've been taking a back seat, but I got to give the reins over to you, as sort of the leading man on the research team. Where should we go from here? What are you looking at in the crypto world? I know you brought some charts.
Yeah. So this is kind of most of the charts I brought today are in relation to ZK Sync and their 2.0 launch of a ZK EVM. If that sounds like gibberish to you, basically the goal is just to take more activity on Ethereum mainnet and bring it onto a layer above that, which is really crucial because gas fees were up to, $200 back in May of 2021, and that's just not feasible for a system that's supposed to be open and permissionless and bank the unbanked. Like no one's going to pay $200 for a transaction. And the reason I'm trying to highlight on this chart basically how Polygon, which is a side chain, don't worry about the nomenclature on that, but it's just another EVM compatible, so Ethereum compatible chain. And as you see, when the Ethereum gas fees spiked, so did Polygon's TVL. So this is me trying to say
locked. That's total value locked.
Yes, total value locked. So the amount of dollars locked in smart contracts on that chain. So it got up to about 10 billion. And basically what I'm trying to highlight here is just to show the audience that if gas fees do pick back up again, if there is something that's more secure than Polygon, like a ZK EVM, that ZK Sync is coming out with, then it might make a lot of sense that they would capture a lot of that migration from Ethereum mainnet to another layer. And yeah, if you go up one picture, Jack, here, this is the amount of gas on Ethereum mainnet spent by L2s to settle their transactions. So L2s are secured by Ethereum because they post all the call data or transaction data that occurs on layer 2 onto the layer 1. And as you can see, it's just steadily been growing. And now it accounts for roughly 3% of all gas spent on Ethereum mainnet. And I imagine over the next 5 to 10 years, that's going to gradually move towards 70, 80% of all settlement costs on Ethereum. And then, okay. Jack, if you can go to the third chart.
Yes.
Unless you had a question on that, Jack.
No, I'll save that for later. Yeah, so this chart, I literally have no idea what any of these words mean. There's not a word on here that I understand.
Yeah. So this is just to try and give a high-level overview of how their ZK EVM works. It's not equivalent at the bytecode level. It's only taking high-level source code. So the smart contract language on Ethereum is Solidity. And basically the whole goal of being EVM compatible is to make it so that developers and users, et cetera, can move over to this layer 2 with very, very little friction, because you don't want them to have to learn a whole new developer language or something like that. So what they're doing is they're taking the Solidity code and compiling it into Yule, which they can then run through the LLVM compiler framework and get it into a language that is ZK EVM friendly. It's really hard to generate proofs. It's a problem that like a dozen teams are working on. So this is their way of doing it. And although it won't be 100% compatible, like 99% of things will be able to port directly from Ethereum onto the ZK EVM. And a lot of projects have announced that they are. I think Aave and Uniswap and a couple others. So it's going to be like a really exciting time. And I know ZK EVMs are very much in their infancy. They're launching on mainnet alpha in 2 days. But that means that it's only open for developers and not users. Like users won't be able to use this tech for probably 6 months or so.
So yeah, ZK is zero knowledge. And by the way, I've always known that. It's not like I just looked that up before this podcast. So ZK is just for zero knowledge proofs, which I understand is a important concept in cryptography. I don't understand why. I'd love your help on that. And then also ZK rollup is ZKR. So why is zero knowledge so important? What is zero knowledge and why is it so important?
Yeah, so there's kind of three angles to try and tackle Ethereum scaling. One is sidechain, and that's Polygon. They're not secured by Ethereum's validator set at all. So it's not nearly as secure as Ethereum. But then you have two really secure options, which are optimistic rollups and ZK rollups that you mentioned. Optimistic rollups use fraud proofs. So it assumes all the transactions are valid that occur and waits 7 days for someone to challenge the validity of those transactions. But then you have ZK rollups, which there is no trust. There's no trust assumptions at all. It's all mathematically based. But the problem is they're really computationally intensive. So that's why what they're building has been so difficult. But it's really important because it's the most secure, it's the best UX, and it's kind of the best tech for long-term scaling. So Ethereum's kind of dedicating their roadmap, to target the future of ZK tech.
Yeah, no, I think Sam kind of painted the picture there. Really, I think like the big takeaway there is Ethereum like isn't that scalable, and it's like very in its base layer state. When there's a ton of on-chain activity, transactions get more expensive. It's a supply and demand for block space, and when they get expensive, it could be like $200 to execute a transaction, and maybe you're only selling like a $50 asset, right? So that obviously like that's not worth it, and that's like not a feasible end state for Ethereum. So layer twos, so like basically extensions of Ethereum, like are the way to scale this. And as Sam said, zero knowledge proofs and like this new technology that's being created and kind of like finalized is like approaching finalization, I should say, is probably what appears to be like the most realistic way to actually create like a secure environment with fast execution that relies on the Ethereum security, relies on Ethereum for security.
Why are you guys so convinced? Actually, yeah. So we'll stop the chart portion of this podcast. So why are you guys so convinced that Ethereum is going to remain sort of the number one? Some people, I've already offended some people by suggesting that Ethereum currently is the number one. I actually don't even know if that's true. I mean, you probably have an opinion on it. I mean, in market cap, Bitcoin is definitely number one. I mean, why not Bitcoin? People talking about the Taproot layer. People talk about all the stuff that's being bid on Bitcoin. Solana's there. Cardano's here. So many other L1s. Why layer ones, which is, I guess, kind of like the main thing. Why sort of, why do you guys like Ethereum so much? And also, not that question, but if a layer one in 5 years, the dominant layer one is something else that's not Ethereum, why do you think you guys will have been wrong? Dan, how about we start with you?
So the way I see the world right now is there's like two ecosystems that seem to be winning, Ethereum and Cosmos. They're both taking slightly different strategies to like reach their scalable end states. But they kind of like both have the same premise that's like more of this modular view than this monolithic view. So like the monolithic view is like everything runs on one chain. So like Solana, they've created this new technology. It's like super high throughput. They can run an insane number of transactions, but like it's still a shaky product. Like it goes down frequently, whereas like the Ethereum network like does not go down. That's something that's kind of like built for liveness. And so I'll let Sam talk about like why the Ethereum roadmap makes a ton of sense and like what they're doing right. But I'll kind of hit on like Cosmos and what that ecosystem is and like kind of what that shape is. And so Cosmos is like essentially a network of application specific blockchains. So each blockchain is built for one purpose. So like an example of this is so on the Ethereum network, you have applications built on top of it because Ethereum is a general purpose blockchain. So it's like creates this base layer security and then applications get populated on top of it. And whereas the Cosmos ecosystem, each app is essentially its own blockchain. So it has its own validator sets and they can like build the rules of this blockchain to specifically facilitate whatever the purpose is. So like Osmosis is an application-specific blockchain built in the Cosmos ecosystem, and like its validator set is it has its own validators, and like the rules of this blockchain are built to specifically be a decentralized exchange. So it's essentially where we have like Osmosis in the Cosmos space, we have like a Uniswap in Ethereum. They're both facilitating swaps between different assets. It's just a totally different approach of how to get there.
But everything in Cosmos is on the Cosmos blockchain, or there are different sort of sub blockchains. And
Nope.
again, to everyone listening, no, yeah, I don't understand this lingo that I'm saying, but go ahead.
So they're each their own like siloed, very independent blockchains, and then in Cosmos. So like there's the Atom chain, there's the Osmosis chain, there's Thor chain, there's Sif chain, there's like all, like let's just say there's only 3 just for simplicity. Like
sure. So how is it all in the Cosmos ecosystem? What does that mean?
So they're like, to be a Cosmos chain, just means you're built with like the Cosmos SDK. The SDK is like a development kit that's basically just like different modules of code that you could like plug and play together to create a blockchain. And then they all use like a proof of stake consensus. And this kind of like allows them to be like on the same wavelength. And then they're all connected through what is called IBC, inter-blockchain communication. So there's this like communication layer where like the Atom chain and Osmosis, so the Cosmos Hub and Osmosis, 2 independent blockchains, are connected with IBC. So if they want to like send assets to each other, they can do that. If they want to send messages to each other, they can do that. And so it's just like in the Cosmos world, you have like this mesh of chains that can all speak to each other. Whereas the Ethereum world, you have like this one base layer security, this one base layer chain with different applications built on top of it. So it's like a different approach. And there's like trade-offs to that, right? Like if I'm a developer and I want to build a decentralized exchange, I have to think, okay, do I want to be an application on Ethereum, or do I want to be my own specific application-specific blockchain that I can like design to be just for my decentralized exchange? And so some like benefits of being an application-specific blockchain are like, front running is a thing in on-chain exchanges, right? Like you can see orders in the mempool, and like if I can see that and I know you're buying this asset, well, cool, I'm going to buy it right before you and then sell it right after you. And now I gave you a worse price for my profit. And so like that's something you can mitigate in a decentralized exchange application-specific blockchain. And then like a big movement we saw recently was like an OG original exchange that was built on Ethereum. So DYDX, it's like a perpetuals futures exchange that actually is leaving the Ethereum blockchain to come be its own application specific blockchain in the Cosmos ecosystem. And there's a couple different things they wanted, but the main reason for this was they wanted to maximize the level of decentralization they had. And they felt that using their own validator set on their own chain, like that gave them the more flexibility, customization, and decentralization than what Ethereum was offering them. So it's just like a different set of trade-offs if you're a developer, like where am I going to build my application? But both seem to be like really promising because a network of blockchains that are all communicating with each other is kind of creating like this modular system of blockchains that like you can still send assets. You can still like the UX is still pretty friendly, just like it is on Ethereum. But again, it's just like a different approach to how you're going to scale into the future. But I'll throw this one kind of over to Sam just so we can kind of give like a different view of how Ethereum plans to scale.
Yeah, for sure. I mean, I just think in my head, it makes the most sense for there to be one secure, censorship resistant, like very solid and slower moving base layer that kind of secures everything on top of it. I don't really understand the Cosmos vision with like fragmented security and then trying to figure out IBC and hoping that there's no vulnerabilities to be found in there when you swap assets from chain to chain. You know, we see bridge exploits literally all of the time. So I don't want to dabble in any of that.
What's a bridge, Sam? What's a bridge?
Yeah, a bridge is basically just to get from one blockchain to another. So if I want to go from Ethereum to Solana, then I have to use a bridge, and those bridges basically lock assets in the bridge, and then they get exploited and people steal all the money in them. And this has happened time and time again, probably $2 billion of bridge exploits in the last year and a half. So I definitely don't like bridges. I think native assets are key in the future. I also just really like the approach that Ethereum is taking as a Bitcoiner. Like, I think decentralization is super important at the base layer, and they're prioritizing a slow base layer in exchange for really good security and low hardware requirements to actually help validate the chain. I think that's critical. And that's why I think Ethereum will end up being the winner. Like, there's no reason that you can't have somewhat centralized layer 2s or layer 3s on top of Ethereum, and maybe even implement some type of regulation on these layer 2s and layer 3s. But I think
Sam, you said, just as a Bitcoiner, how do you envision the future of Bitcoin? And look, coming from the macro world, I'm familiar with all the narratives of like it's digital gold. There's only 21 million of them. I'm not looking for that. I'm looking for like the technology layer, like what's going to be keeping Bitcoin like dominant, and like, if the biggest coin and the most sort of popular coin in people's imaginations, like or thought, like what's coming on the pipeline. Dan's
from the
laughing, by
tech
way, for people.
From the tech side of things, something promising I actually heard on another podcast recently was the founders of Starkware talking about how Starkware is an L2 on Ethereum. They're like on the cutting edge of ZK tech that we just talked about, and they do Starks and not Snarks. There's two different kind of ZK proofs, and Starks, everyone said, no, these can't be done. You're not going to be able to do this in a blockchain, and they figured it out, and they're really passionate about Bitcoin too. So they're like, if we're like, once we get in a good spot with Ethereum, we'd love to go over to Bitcoin and see if there's any way that we can do it. And there's also people researching how to use ZK proofs with Bitcoin to provide some kind of DApp environment on Bitcoin. But outside of that, it's all really speculative. I think it's years and years out for there to actually be, an Aave or a Uniswap on Bitcoin.
Why is that? It's the oldest one. It's the OG. You think that? By the way, you said DApp. That's decentralized app. So why is it that the oldest cryptocurrency is it's going to be years out until they have stuff on top of it? What about what's it called? Taproot. I've heard these names bandied about, like all this. What's going on here?
Yeah, Taproot, in relation to the merge, like it took Bitcoin years to get Taproot through, and for the merge also took a long time, but the difference in scale between the accomplishment is pretty large. Like, Bitcoin just moves incredibly slow, but that's also one of its main value propositions. Like it is what it is. It's a finished product. There's only 21 million, like you said. So yeah, I think that Bitcoin's value is that it moves slowly, and then Ethereum is more far out on the risk spectrum. And like, hey, like we're trying to develop a world computer with decentralized ecosystems and finance and gaming and the metaverse. Like, I just think that, Bitcoin's better off trying to maybe work on the Lightning Network and doing like micro payments across that as the capacity grows and more channels open up, than they are trying to compete with Ethereum on a space that they're clearly the winner on right now.
Makes sense. Dan, are there any other competitors other than ETH or Cosmos that you sort of have your eyes on? And just on the research team, how many of your articles are about things that are not part of the Ethereum or the Cosmos ecosystems, those two ecosystems? How many things do you write that are not about that?
So I'll kind of work backwards to the questions. So first, on the first question, we really only focus on like DeFi assets and layer ones. We're passionate that like DeFi will be likely to be the first application that's like heavily used for the average user. I think the other application could potentially be gaming, but that's really yet to be seen, and really a whole other conversation. But yeah, so we focus mostly on DeFi, and a lot of that is currently happening on Ethereum. That's just the largest ecosystem where this is going down. Cosmos is kind of becoming this growing ecosystem that we are paying close attention to as well. Solana is another covered asset that we stay on top of. We're watching what's going on in Avalanche as well. It's really just like my personal view that Cosmos and Ethereum are going to be like the winners here, but we do cover, what's going on in the other layer ones, like who's building what. Like Aptos recently just launched. We're not covering Aptos officially, but like this is something we're still paying attention to. These things do like deserve to be explored, even if like my personal views or Sam personal views like don't necessarily think that these are going to be the winners. That's you have to like give a reason why, right? So like experimenting on these chains, seeing what's going on is definitely important to do. And so On the Bitcoin question, though, I would probably take the opposite view. This is like in our analyst Slack channel. This argument goes down at least once a week, I think. But yeah, I think like the flippening where the market cap of Ethereum like increases to over the size of Bitcoin. I think that's like inevitable, right? Like Bitcoin wants to be like this hard money, which I first of all, I'm not bearish or bullish on Bitcoin. Like I'm pretty neutral on the asset. I think what it does is great. I think its most important quality is, like Sam said, it's like it's simplicity, right? Like it's just this hard asset with 21 million gold-like properties. But what's the market cap of gold? It's around like 10 trillion, right? Personally, for me, like Ethereum is trying to build a global digital economy, and in a world, in a day and age where like everybody's becoming increasingly ingrained with technology, and moving online is like a pretty easy concept for most people to grasp. Like, you walked out, you go to like lunch at a restaurant and you see like a toddler just like knowing how to use an iPad. You're like, these kids are growing up with technology. So like the shift to online for that age class that's like a no brainer. And I think that's like, pretty commonly held belief. So like the shift to like an online digital economy, personally, like that is more valuable than $10 trillion. Like that's like, we're going to be a massive asset class. Digital economies will have massive scale. I think Ethereum is a very likely winner in this in that market. And so, yeah, I personally am a strong believer that Ethereum will be worth more than gold.
That makes sense. And I'm saying that like that makes sense. I'm not agreeing or disagreeing, but yeah, I mean the global economy really took off once it left the gold standard. Like gold is great. Don't get me wrong. I have no beef with gold, and Bitcoin is great too. It's digital gold, but like when you go to the Starbucks, it's hard to pay in gold. And like if Bitcoin is the hardest money, which I think a reasonable case can be made that it is. Like you don't want to spend hard money. Like Gresham. People always talk about Gresham's law, but yeah, that means that the hardest money will never be spent. And it's like, we'll just live in this like deflationary world where like no one spends any money. If Bitcoin was the only money, like no one would spend it because it's too valuable to spend, so we're all become like King Tut, where we just like bury ourselves with all this gold. And there's
right.
No
and like the Lightning payment is like a great use case. Like micropayments make sense, but then to your point, why would I want to spend this money? And two, like Ethereum gives me the ability to use stablecoins as payment, right? Like I can have one USDC and, or maybe like 5 USDC and buy a coffee. And that's like a more realistic application than like spending 0.001 Bitcoin on a coffee. Like that mental translation makes, it's a hard grasp. I just think stablecoins are very likely to be the most prominent use case of blockchains and like in terms of like daily life transactions. And yeah, that lives on Ethereum.
Guys, as we reach a close, I've asked all these questions to you about crypto. Do either of you have a question for me about TradFi or macroeconomics?
Dude, this is a good one. Yeah, I'd love to hear your like 6-month outlook and like mainly as it pertains to like tech stocks, right? Because in essence, crypto trades quite similarly to like a high beta tech stock. So love to kind of get your take on where you see the tech stocks of the world going over the next 6 to 12 months.
Thanks. That's a really good question. Tech stocks, stocks that are profitable technology companies, they have earnings in the future, and those are valued at a certain rate, and they're valued according to how fast they grow, how high the quality is. So like if you have a company that's reporting, billions of dollars of profit, but it's like, is all this just network, are we dealing with an Enron here? Like maybe the valuation will be a little bit lower, but if it's like pure, like, oh my God, this is growing 80% a year and like the cash flows are pristine, that will command a higher price to earnings ratio. Most of the fall in tech stocks this year, I'm talking about the blue chips names, Apple, Microsoft, Google, we'll leave Facebook aside, has been the price to earnings ratio, forward price to earnings ratio, falling because the price has gone down. The earnings are still going up. They're maybe not going as much up as much as they used to, because tech stocks had enormous growth in 2020, but particularly 2021. However, it's just been like the valuations have compressed because bond yields have risen. So like the future isn't what it used to worth. So the future isn't worth what it used to be. So like a company that, the majority of its profits, most are going to be made past 2028. That would be a company that would have been hit the hardest, particularly if it is not profitable now, which actually many companies are. Even blue chip names, if you count actual things that do cost money, like stock-based compensation, it may not cost US dollars, but it does cost shares, which is a form of money. I mean, that's why companies buy back their own stock. Then, some companies are not profitable. So that's sort of just like laying out the case for why tech stocks haven't performed well this year. So the first shoe to drop was bond yields rising. Do I think that they will rise farther? Maybe, but I think we're pretty close. Like a 10-year at 5%, like I don't think it's going much higher than 5%, So now it's like 4.1% or maybe a little bit lower. So the question is, the next shoe to drop going to be earnings? I don't know. I mean, Google reported their earnings at Microsoft yesterday, last night, and their revenues actually went up. It's just that their costs went up too. So it's the cost of inflation. So I guess actually that is a case that the earnings will go down because revenues do increase, but the costs increase too because of inflation. Yeah, I mean, you asked me my outlook on tech stocks. I think that whatever tech stocks will do, just because they're so large, the S&P 500 will do as well. The NASDAQ will do. I mean, NASDAQ is majority tech stock. S&P 500, Apple is 6% of the entire index. Yeah, I think we got another leg down. That's my question. But I don't know it for sure. But I would say I have a reasonable degree of confidence that it will go down. Just because I don't think bond yields may stop rising, but I don't think bond yields will fall. That's my highest conviction view, is that a Federal Reserve pivot, like the P word as people are calling it, which is like, interest rates are actually going to go down. Like the Fed is going, oh my God, the Fed's going back to zero. That is not going to happen for the first half of 2023. Like, there's no certain things in finance, but it's like, I have the same level of confidence about that you have, that like some L1 that, a lot of people like is just not going to make it. You know what I mean? Like I'm pretty confident that there will be no cuts. There may be the Fed, currently the market's hiking, projecting, we get to 5% and we only get to 4.5%. But there will be no like realized cuts. Some people say, the fact that we've stopped cutting, that itself is bullish. Okay, fine. I don't know. But that's what I think. Sam, you got a question for me?
Dan, that was a good question. A hard one to follow up. But I guess I would ask, with the dollar strength, we've seen things like the yen getting devalued and the Bank of Japan intervening by, selling US dollars for yen to try and, defend the currency. And then we also see like things like the Bank of England starting to see some stress in their pension system. So my question for you would be, even if your base case that you're very confident in that the Fed P word is actually going to end up being, remaining neutral and staying at that 5% target or whatever your terminal rate is, do you think that contagion would potentially force, and specifically contagion amongst other sovereign nation states, would force the Fed to pivot?
Fantastic question. As defined by, if a pivot means cutting rates, I think no, until like the second half of 2023 at the earliest. But if we're talking about targeted interventions where the Federal Reserve says, this 20-year Treasury note is looking pretty weak. We're going to, over the next week, we are going to be doing $5 billion a day or maybe $10 billion a day. Just a little liquidity support. It's just a facility. We're not pivoting, Sam. It's just a facility. And that's kind of what they did in 2019, where they stopped doing quantitative easing, quantitative tightening. They were actually reducing their balance sheet. And I think they stopped reducing the balance sheet, but they were not doing quantitative easing in 2019. But they did a little intervention where repo rates spiked to very high, and they had a $500 billion standing repo facility where they said, look, we're going to lend essentially an unlimited amount of money. Like if the market needed 600 billion, they'd make it 700 billion. It's like as much money as you need. And that's not giving people money. That's just lending against very sound collateral. So people called that the QE that wasn't the QE. They call it like not QE, So do I think there will be another not QE? Yeah, definitely. And I think that if there is a Fed, I don't think that's a P word though. Like I think I think that many people will declare victory and say that an intervention will be a P word, but I don't think it will be a P word. I think a P word will have to be truly cutting rates. And I also don't think that it will do quantitative easing. It will do not quantitative easing, which is by like sort of, we're gonna make something happen. Look, Sam, you're the bond market, I'm the Fed. We're gonna make something happen. Okay, we're gonna make sure we have a deal. We're gonna make sure everyone goes home and is happy. But are they going to actually be increasing their balance sheet again? The Bernanke doctrine is that no, that rates like QE should be an extraordinary measure where interest rates should be at zero, and then we're at zero, but there's still a depression. Like then we do QE. So it's considered like forbidden, kind of, by central banks to do quantitative easing when rates are higher than zero. And we're extremely higher than zero, and we're going to get even more higher than zero. So yeah, my base case is no interest rate pivot until second half of 2023 at the very earliest. Definitely no quantitative easing that is called quantitative easing by the Fed, like a nominal increase of the Fed's balance sheet. I don't think they're going to sell treasuries or sell mortgage-backed securities. I think they're going to let it roll off, and that will be a maximum of $95 billion a month. But it effectively will be less because there are fewer mortgage-backed securities that sort of meet that cap. But yeah, will we have a Bank of England type intervention? Yes. Is that my base case? I don't know. It's kind of like 50-50. I just spoke with Lynn Alden, and she's pretty convinced. Yield curve control, where the Federal Reserve says, actually, the 10-year Treasury yield can't go above 4%. And if it does, if someone's foolish enough to short the 10-year Treasury bond, we're going to buy it back from them and impose on them a loss. That's what the Bank of Japan is doing with the Japanese government bond market at 25 basis points. No, I think yield curve control is a more extreme measure than quantitative easing. I mean, quantitative easing is a limited amount of purchases like every month, whereas yield curve control is targeting a specific level on the yield. And if the yield stays there by itself, you don't have to buy anything, or you can even sell. But quantitative easing is like a certain amount every month. So yeah, that's my base case. No QE, no Fed pivot, no interest rate cuts, but a targeted intervention to fix the bond market. Sure. I mean, we're recording this on Wednesday, October 26th. About a week ago, like maybe the 19th, the 18th, 20th, somewhere on there, the long end of the Treasury market was looking very weak. I mean, TLT went from which is an ETF that owns like long duration Treasury bonds, went from like 102 to like 93 in like a few days. And that's not something that should happen for like the safest asset in the world. Yes, it has tons of interest rate risk, but yeah, things are melting down. People are constantly talking about how liquidity is so poor. So I think, I'm not focused on the P word. I'm focused on the I word, intervention. And yeah, I think that could definitely happen. As early as like it could happen in 2022. Do I think that's my base case? No, but yeah.
Okay. And with that outlook, sorry, last question. With that outlook, do you think that equities or bonds can actually rally in the face of all this macro uncertainty and amongst central bankers?
I think bonds can rally. Yes. I think the 2-year Treasury yield, which let's just say was at a peak of like 4.5, 4.6%, that was pricing in a terminal rate, like the peak of the mountain, the highest the Fed gets in April of 2023 to be 5%. If it's, quote, only 4.75%, the 2-year Treasury yield can actually fall, and it's been falling over the past 2 days. If I'm right about no pivot, then it can't fall that much, but it can definitely like rally a little bit. And if you use leverage for like Eurodollar futures, something that can be a profitable trade. Yeah, I think 10-year can rally, and bonds go up, yield goes down. Same with 30-year stocks. I'm having a little bit of a harder time seeing that picture. Like I'm talking like longer term, like 3 to 6 months, or even like the next year. Obviously, we're in the middle of like what I would consider a bear market rally, which is kind of weak at this point. Like S&P 500 is like trying to get to like 3,800, which, 2 months ago we'd consider that low, but now we consider that high. Stocks, I'm having a little harder time getting there because I think we are headed for a recession that is quite. It's not going to be good. I think we're headed for a recession, and I think whether we're in it already or we will, the dating committee will actually say, oh, it started on November 3rd. It doesn't really matter to me, but yeah, economic growth is slowing. Not a great time to own stocks. That's just been the playbook, and like a lot of rules you could throw out the window this year, but I think that's still the case. So we'll see. Unless you have another question for me, I think we should end it there. Dan, where can people find you on Twitter? Sam, where can people find you on Twitter? And where can people find the excellent work of Blockworks Research, as well as the podcast, which airs on November 2nd?
Yeah, absolutely. I'm a SMY guy on Twitter, Dan Smith. It shouldn't be too hard to find. There's only one Dan Smith in the world. Thanks, Mom and Dad. Still giving them heck for that one. But Blockworks Research is at Blockworks Res on Twitter and blockworksresearch.com. Lots of great insights. We have a ton of great free reports out there as well. So even if you're not a subscriber, you can still kind of get a flavor for what exactly it is we write about, what kind of like where our heads at, where our heads are at, kind of like what we're focused on. And every time we drop a report, whether or not it is free or behind the paywall, we do put out a pretty solid Twitter thread, kind of just like highlighting important things in that report. So definitely be sure to check out the Blockworks Research Twitter account. And
Sam, where are you on Twitter? And also, where can people find the Blockworks Research daily newsletter, not the excellent newsletter that Byron writes, but the more specific, I think it's called the Daily Debrief. Where can people find that?
Yeah, so you can find me on Twitter at SWMartin19. Sam Martin is my full name. And for the sign up link for the newsletter, we always put in like really good commentary on kind of everything you need to know on crypto, and then governance related alpha, or like maybe some trade ideas or free NFT mints, or anything along those lines. So it's a nice place to get all the stuff you need to know on the day in like 5 to 10 minutes. And we can include a link for that in the show notes as well.
Wonderful. Dan, Sam, thanks so much. And thanks everyone for watching.
Thanks, Jack.
Thanks for having us on, Jack.